A lot of hand-wringing going on today. Are you wringing yours as well?
Well, we're certainly paying close attention, but I really like that you went to Rick and what he said about this being a bond story. That's what we were looking at right before we came over here. We saw a lot of hedge funds coming into this week very short the long end of the bond, and we think we need to see some of this lower oil prices, some of these inflation expectations flow through, and then weigh what's going on in the bond market against some of the earnings and buoyant views on economic growth that we are getting in some of the leading indicators.
Well, when you put that all together, what does it say to you? Are we going to see a slowdown or not? Do you think?
We don't think that a slowdown for the global economy or the U.S. economy is coming in the next 6 months. We do think this is a period where we would want to be overweight in global equities because the U.S. is a little bit more expensive than the rest of the world, but we want some other positions around that. So we also are overweight in U.S. dollar sovereign emerging market bonds, and we have some hedges in there. So we've been long the U.S. 10-year and are pleased to see that no longer expectations are this thing is going straight to 4%. We're actually below 3% now.
Right.
So, Mark, when you were talking about the positioning of the hedge funds coming into this week in terms of being short the longer end of the yield curve, what you're seeing then, if I can connect the dots, is basically a short covering rally, which is sending the longer end of the yield curve lower. And so, therefore, do you expect that to snap back anytime soon? And so some of the trades in the market that we're seeing put on today on an inverted yield curve or a yield curve that is flattening, such as a sell-off in financials, is that short-lived?
Well, I think that's the question, how short-lived it is, whether it's one day or something like that. But that is exactly what we're watching. That this view that the rates are going to continue to rise, that is rolling off, and people need to reposition.
So Mark, let's talk about this repositioning. We've mentioned it a lot. You've mentioned it a lot. Is it positioning in the Treasury market? Is it positioning elsewhere? So as you talk to your clients with that $2.4 trillion worth of assets under management, how exactly should they be positioned? Are they still risk on at this point, or are we kind of feeling this is going to be more contractionary going forward?
Yeah, look, the one thing about having clients all around the world is the views are different, and I think that's particularly important at this time because, remember, the investors in Europe and in Asia, they started feeling pain in the market much earlier. And so we've got valuations in some of the Asian markets where they're trading about 20% above where they traded in the crisis on a book value basis. So that's why we see some better valuations elsewhere outside of the United States. And we are seeing some people who respond to that and say, okay, maybe things can get a little better now because we've had such a sell-off.
Now, J.P. Morgan says cash is king. Obviously, you disagree with them, but they're looking at trade headwinds, not just the trade dispute with China, but slowdowns among our major trading partners, including China and Germany and Japan. They're looking at other variables that are causing some sectors to show signs of wear and tear here in what has been the longest bull market on record here. So putting that in perspective, how do you justify your positioning right now?
Well, I think that what is right to do, if you look at last week, if you look at this month, if you look at the big themes for next year, there is a tremendous amount of uncertainty around Federal Reserve policy. Remember, we were supposed to get away from the Fed driving everything, and then also the trade policy. And those are two key factors which the market is having a lot of difficulty pricing in right now. Remember, a lot of the sell-off in the United States started in October when Chairman Powell really established his bona fides as considered to be much more hawkish than the market thought. I think we took a little bit of comfort in last week and this week in that it looks like the Fed and the president are not just dogmatically following a policy without any regard to what's going on in the markets and the economy. Perhaps they are a little data dependent, but with this back and forth on the trade today and what actually was said, I think that is contributing to what we see in the sell-off today.